The history of money is pretty fascinating. It's a story of how humans have exchanged value over time, from simple bartering to the complex financial systems we have today. Here's a brief overview. The beginning. Barter and the rise of trade. Barter system, prehistoric times. Before money existed, people engaged in barter, exchanging goods and services directly. Early human societies lived in small, self-sustaining communities. People would produce what they needed, such as food, tools, and clothing, and trade surplus goods. For example, a hunter might trade a deer hide for some grains or fruits. However, the barter system had obvious limitations. Double coincidence of wants. For a trade to happen, both parties had to want exactly what the other offered. If a blacksmith wanted some grain but the farmer didn't need any tools, no trade could take place. Divisibility. Not all goods are easily divisible. A cow is hard to split into smaller units of trade, unlike something like grain or precious metals. Despite these challenges, bartering worked for a long time and laid the foundation for more advanced trading systems. The birth of money commodities, commodity money, around 3000 BCE. Eventually humans realized that certain items had inherent value that could be used as a medium of exchange. These commodities were typically things people already valued for their utility or scarcity. Livestock. In many cultures, cattle were the first forms of money. They were valuable because they provided food, clothing, and labor. Grain. Ancient Mesopotamians used barley as money. The value of grain was tied to its ability to feed people, which made it a natural choice for trade. Shells. In some parts of the world, such as Africa and the Pacific Islands, cowrie shells were used as currency due to their rarity and ornamental appeal. Commodities as money allowed for more efficient trade but still had limitations. For example, if you were a skilled metalworker and wanted to trade for a herd of cattle, transporting the cattle might be impractical. This is where the next innovation came in. The coinage revolution, metal coins. The first coins, around 600 BCE. The idea of metal coins began in the kingdom of Lydia, in modern-day Turkey. The Lydians were the first to create coins made of electrum, a naturally occurring alloy of gold and silver. These early coins were standardized in size and weight, making trade much easier. The Greeks and Romans soon adopted the idea, and coinage spread across the ancient world. Coins provided several advantages over earlier forms of money. Standardization. A coin's value was guaranteed by its weight and metal content, which simplified trade. Portability. Coins were much easier to carry than, say, cattle or grain. Durability. Unlike goods like grain or livestock, coins didn't spoil or decay. The Greeks and Romans used coins extensively, often stamping their likeness on them to reinforce the political power behind the currency. This also marked the beginning of symbolic value in money. Money wasn't just a commodity anymore, but also a tool for communicating political authority. The rise of paper money, a revolutionary shift. Early paper money in China during the Tang dynasty from 618 to 907 AD marked a significant leap forward. While coins had served civilizations well for centuries, they had significant downsides such as their bulk when used in large quantities. Around the 7th century, paper money was invented in China during the Tang dynasty, though it became more widespread under the Song dynasty from 960 to 1279 AD. These early forms of paper money were essentially promissory notes issued by the government, representing a promise to pay a certain amount of precious metals like silver or gold on demand. This innovation was inspired by the problem of transporting large amounts of coins, especially for merchants traveling long distances. Instead of carrying heavy metal coins, they could carry paper certificates representing that value. China's paper money system laid the foundation for the concept of fiat money, where currency has value not because of the material it's made from, but because the government says it does. Medieval and Renaissance banking saw the emergence of early banking systems. During the Middle Ages in Europe, the need for more complex financial systems became clear. Merchants and bankers began issuing paper bills of exchange, which were essentially early forms of checks or promissory notes. The rise of the Italian city-states like Venice, Florence, and Genoa became key players in developing early forms of banking. Merchants could deposit money and receive receipts they could redeem in different cities, making it easier to conduct international trade. The Medici family in Florence was one of the most famous banking families during this period. They developed methods to create letters of credit and loans that laid the foundation for modern banking systems. It was during this time that banking began to move from physical commodity exchanges to systems based on trust and credit. The gold standard marked a new era of currency in the 19th century. By this time, many nations began to adopt the gold standard. Under this system, countries agreed to fix the value of their currency to a specific amount of gold. For example, the British pound or the US dollar could be exchanged for a set amount of gold. This system was seen as a way to stabilize currency values and facilitate international trade. The gold standard had several advantages. Stability, since gold is a tangible and scarce resource, the value of currency was tied to a real asset. And trust, as countries adhering to the gold standard had international credibility, knowing their currency could be exchanged for gold. However, the gold standard also had serious drawbacks. It limited the amount of money governments could print since they had to have enough gold to back their currency. This became especially problematic during times of war or economic crises, when governments needed to issue more money to finance operations. The collapse of the gold standard and the rise of fiat money marked a significant turning point. The end of the gold standard began during World War I, when countries needed to print large amounts of money to finance the war effort. Many nations temporarily suspended the gold standard and started printing more paper currency. By the time of the Great Depression in the 1930s, many countries, including the US, abandoned the gold standard entirely. The Bretton Woods Agreement of 1944 set up a new system where the US dollar became the world's reserve currency, tied indirectly to gold, but other currencies were no longer directly tied to gold. In 1971, President Richard Nixon took the US off the gold standard completely, marking the full transition to fiat currency. This meant that the US dollar and most other currencies around the world were now based on trust in the government that issued them rather than the backing of a physical commodity. In the late 20th and early 21st centuries, technology revolutionized how we interact with money. Digital payments became ubiquitous. Credit cards, debit cards, and electronic transfers allowed people to move money without ever needing to handle physical cash. This made transactions faster and more efficient, especially as global trade increased. In recent years, the cryptocurrency revolution has introduced a whole new era for money. Bitcoin, created in 2009 by the pseudonymous figure Satoshi Nakamoto, was the first decentralized cryptocurrency. Cryptocurrencies are based on blockchain technology, which is a distributed ledger that records transactions across many computers, ensuring transparency and security. Unlike fiat money, cryptocurrencies are not controlled by central banks or governments. Their value is determined by supply and demand on open markets. This has led to significant interest in digital currencies as both a store of value and a potential alternative to traditional banking systems. As we look to the future, the role of money continues to evolve. Digital currencies, government-backed central bank digital currencies, and artificial intelligence are all shaping the future of financial systems. With the rise of decentralized finance platforms and the increasing use of blockchain in various sectors, the world might be moving towards a more globalized digital economy. From bartering in the early days of civilization to today's complex financial systems and digital currencies, money has undergone a radical transformation. Each shift in the history of money has been driven by changing economic needs, technological advancements, and new ways to store and transfer value. The history of money is not just a story about economics, it's also a story about how human societies have evolved, how trust has been built and broken, and how technology has continuously reshaped the way we think about value. Please drop a comment of what you think about the evolution of money. Thank you for watching.
Thank you for watching. Kindly like, comment, and subscribe. Click on the notification bell so you can be alerted anytime a new video is uploaded. And please, don't forget, share and be a blessing to someone. God richly bless you. Shalom.